Okay, thank you very much. My name is Paul Forcioni, and I am a trading coach with Discover Options, which is the educational division of the OptionView software company. What I want to do today is use the OptionView software to share with you, I think, a rather unique options strategy. I say unique options strategy because it is a way of basically trading in a very risk-averse, low-margin fashion. It's a technique for trading option spreads that have low delta, so the position is not overly affected as the underlying commodity moves. It's a position that also has low gamma, so the change in the deltas as the market moves is not very dramatic. In addition, it has low vega. And when I say low vega, what I'm referring to is insensitivity to implied volatility. Bear with me for one moment.
Testing. There we go. Okay, we can hear you, Paul. And yeah, you just click on the Start Desktop Sharing at the top.
Were you able to hear what I was saying previously? Okay, are you able to hear me loud and clear? Having a little difficulty here. Let's see. Okay, there we go. I'm not sure if any of you heard what I was saying earlier. Let me start over again to make sure that we do get this from the very beginning. And I'm a trading coach with Discover Options, which is the educational division of the OptionView software company. And what I'd like to do today is to show you folks how I use the OptionView software to create and manage a rather novel options strategy that can be used in certain futures and commodity markets. And I say a novel strategy because it is a risk-averse margin way of trading options. It's a technique for putting on options spreads that have low delta, low gamma, and low vega. I'm sure many of you are familiar with the Greek variables. It's not overly sensitive to movement in the underlying commodity. The deltas do not change very rapidly, and the positions are insensitive to changes in implied volatility. That's very, when you look at a typical volatility chart for a market like gold, and that's what we're looking at here, it doesn't quite fit on
he's just getting his chart set up, and then he'll be on in just a few minutes. I'm just trying to get everything set up here.
Yes. Are you not able to hear what I'm saying? I think everyone can hear me. Okay. So what we're looking at here is a bar chart of gold futures contracts, and underneath the bar chart is a blue implied volatility reading. Implied volatility, as you can see, fluctuates quite dramatically as the market moves, and it fluctuates in a very erratic fashion. When you look back at this chart to August of this year, it was the beginning of a big rally in the gold market. Take a look at the blue implied volatility line over that same period. it fluctuated all over the place in a very unpredictable fashion. Same thing with the period from October to where we are today. We've had volatility in a choppy move, especially to the downside in the last couple of weeks, despite the movement in the gold futures. So having an option strategy that can remove the sensitivity of your position, the performance of your position, to fluctuations in implied volatility is quite important, in my opinion. So what I'm going to show you is how you can create a strategy of that sort. So what we will do is go back to our matrix or our quotes display in option view, pull up the matrix, which shows us all of the various futures contract months along with the corresponding options and strike prices. And I'm going to create a position and talk you through it. We've got gold in the month of February, gold December or February futures trading at 1725. So if we take a look at the January options, which are tied to the February futures, what we're going to do if we want to create a bullish position in gold, we'll go back and create a bearish one later, but if we want to create a bullish position in gold, the first thing we're going to do is go to the at-the-money put, the 1725 put in February, and sell that. Why do I choose the at-the-money put? Because the at-the-money put, at-the-money options have the greatest time value. They will create the most positive time decay. Now we want to hedge that 1725 at-the-money short put by purchasing, you could say insurance, further out of the money. We'll go all the way down to the 1675 put. So we have created a bull put spread, a credit put spread. That spread by itself is a trade construct that I'm sure many of you are very familiar with, and it has the following characteristics. Let's see here. I need to get this screen the right size so I can achieve the what I need to do. The screen is a little bit too small for me to, let's see, let's do it this way. Bear with me, folks, while I get this to show properly. Well, it's reconnecting, it says, my projection. Sorry about this, folks. It looks like it's hung up for the moment. Let's see if we're going to get some luck here. Okay, it looks like it's going to come back here. Okay, I think we're getting it back. Here we go. There we go. Okay. We have option view back. I need to get this to the proper size so that I can show you the graphic analysis. And that's where I'm having a little bit of difficulty. Let's see what I can do here. Yeah, it's okay. This is not working the way I was hoping it would. Let's see here. I'm going to minimize that, bring it back, try to get the size where we can show what I need to here. Well, this is rather unfortunate. Without being able to see the graphic analysis, I'm not going to be able to do this presentation as I would like. I know there has to be a button so I can fit this to the screen, but it doesn't seem to be working. If I minimize, and let's see, let me try this. No luck.
Hey, Paul, this is Chuck. I just went ahead and stopped that projection. Go ahead and get everything the size you need. Once you have it sized, we'll restart the projection.
Okay.
And what you probably could do, just go ahead and be full screen, and we'll just let everybody know to save the questions till the end of the presentation.
Right. I am attempting to do that right now, and for some reason it is not not allowing me to do that. I'm not quite sure why.
Okay. Well,
Okay, there
yeah.
we
Well,
go.
once you get
That's the screen size. That's it. I've got the screen the way I need it.
All right. Now let's go back to the chat room, restart the projection, and then get back to your software.
Okay. It is connecting. Okay, now is that something you're able to see okay? Looks like it's pulling it up on
Yeah, it actually hasn't loaded.
the screen right now. Let's see. Okay.
All right, let's try and go back and shut down that projector and reopen it.
Okay. Well, it's tempting to reconnect with the projector. Doesn't look like we're having much luck here.
All right, Paul, what we may have to do, try to log out of the room and come back in. Now, I realize this is taking up a little bit of time, so we'll extend your time on the back end. But maybe that'll help us out a little bit, sort of reinitiate the connect.
There we go. Hmm. Okay. It looks like my entire screen is hung up and I can't even use my mouse. I'm really sort of stuck here, unfortunately.
All right, so let's try and do this. Paul, are you going to be free a bit later today?
Yes, I will. Uh-huh.
All right, I'm going to give you a call in a minute, and I think what we'll do. Obviously, we're having a few problems here, and we do have Brian scheduled to come on in about 7 minutes. So let's try and get you set up for, say, about, I think, 2:30. I'm trying to look at my schedule and see when our last presenter is on today. I think Jason goes from 1:30 to 2. So if we could have you come back in about an hour, see if we can get some of these issues fixed between now and then, and we'll basically just change the schedule.
I think, yeah, and I think you'll have to get me out of this room because I'm not able to. My mouse is disabled and I can't even close this down.
Okay, I'm going to take your microphone off here, and then, actually, I don't know if I can.
Hmm. Perhaps the only thing for me to do is just power down my system and then I'll be out and you'll be able to do what you need to.
Yeah, looks like it. And guys, we'll have Brian Neal on in just a few minutes. Brian, are you listening right now?
Yeah, yeah.
Okay, I need you to take your mic down just a notch or two.
Okay.
All right. Are you going to be ready to do your presentation?
Yeah, I'll be ready here shortly. Right now, actually, is the slideshow already put in there?
Yeah, I'll get those loaded up. And let's see. So change the schedule here, guys. We're going to get Brian to come on a little bit early, and we'll have Paul come back and join us at the end of the next presentation. So we have Brian Neal of TradeToBeFree.com. There you see his information, and we'll have Paul Forcione join us at 2 p.m. So in about a little bit over an hour. All right, let me reset the timer here. And Brian, I'm going to give you 34 minutes because that's how much time we have till our next speaker is scheduled. So the room is all yours.
Great, I'll have some time for questions then. All right, thanks, Chuck, and I really appreciate the opportunity to speak to everyone today. I'm Brian Neal, founder of StrategyFree.com, and today I'm going to talk about something a little bit different than what we've talked about so far. We're going to talk about fundamental analysis and combining fundamental with your technical analysis in your trading, and how to find stocks with the right fundamental characteristics that are positioned and poised to explode higher in the near future. So this will be a little bit different than what you've seen so far, but give you another way of improving your results by taking a look at certain fundamental characteristics that will help you do better. And I'm going to, in this presentation, I'm going to show you the perfect trading setup. I'm going to go over some of the philosophy that we have, and I'm going to show you how we implement the philosophy of our trading in two methodologies, one on Trade and Be Free and one on InvestBeFree.com, and show you some of the amazing results that we've seen so far. But first I want to just take a step back and go over what traders usually use in their trading, and that is technical analysis. During the presentations today, we've seen a lot of information on Fibonacci analysis, a lot of other technical analysis tools. Traders might use this. These tools that we talked about today, they might play chart patterns, they might use candlestick patterns, they might buy breakouts, they might play gaps. But it's always trying to play momentum and or trying to take advantage of an oversold condition before a stock starts another move higher, or vice versa if you're shorting the market or a stock. So, and typically investors look at fundamentals and don't look at technical analysis at all. So traders use technical analysis and pretty much ignore fundamentals. And typically, while investors generally look at fundamental analysis and don't care too much about technical analysis. But actually, some of the best traders out there use both. And for instance, the all-time record holder that set the record back in the late 90s during the epic bull market we had back then, and top fund managers, people win trading contests, etc. A lot of those folks use a combination of both technical analysis and fundamental analysis. And why wouldn't you? You've got to, you want to trade a price trend in your favor and ride that trend higher. You want to play those technical entry points, but if the underlying fundamentals of a stock are also trending higher as well, that can give you an edge in your trading, and that's a match made in heaven if you're a trader. If you can have both the price and the fundamentals moving in the same direction, that can really help you become more successful as a trader and more confident. And I want to talk right now about the fundamentals that really matter in trading. Two areas of fundamental analysis, two characteristics of stocks that tend to lead to higher prices and are proven to lead to higher prices in the short term. And when I say short term, I mean over the next few weeks to couple months at least. And those two characteristics are strong and consistent earnings and sales growth. Companies that have they're growing like crazy, are opening more and more offices, are providing their product or service to more and more people, and growing their company very quickly, and also companies that are beating estimates with estimates, future estimates that are being revised higher. And so estimate revisions, what those are just the estimates for the future, earnings estimates being revised either higher or lower. So that's what the term estimate revision means. And it's been proven that companies with rising estimates that tend to beat those estimates do better in the short term than the average stock. One proof of that is the Zacks ranking model, which has been around for about, I think it's been around for about over 25 years now, around 25 years. And what they do is they rank stocks based on their ability to beat estimates and also that whether their earnings are trending higher or not. And the companies that have the higher ranking tend to beat estimates more with their estimates tending to move higher. And their ranking model, I think, has made, according to their site, between 25 and 30% per year gains, and really clobbered the market over the past 25 years. And it's been pretty consistent year in and year out. And so if we can, combine these factors or look at these stocks, find these stocks that are, beating earnings with rising estimates and we're growing quickly, along with other key characteristics, we should have a pool of stocks that tend to beat the market regardless of the fundamentals, at least in the short term. So I want to illustrate the importance of using or finding these type of stocks by looking at a trading setup that came up earlier this year for a lot of traders. This was a small gold stock, and the reason I bring this chart up is that it was in a very bullish chart pattern back then. The stock went into a bull flag or high tight flag, which occurs when the stock moves up very quickly and makes a huge price gain within a couple months, and then moves sideways for a few days to a few weeks, and then starts this next move higher by breaking out of, in this case, the downtrend and the pennant. This is more of a pennant, more so than a flag, but my point is that it broke out of a very strong chart pattern, and unfortunately, it didn't have the rising estimates. It didn't have the strong track record of growth, and it was much more speculative in nature. And we can see that after it broke out of this strong chart pattern, it actually broke down, broke through one support level, and then later crashed through a second support level. And some folks who waited till after the stock closed below this support level right here would have been really awakened to a big drop in the price here in June, and would have lost quite a bit on this trade. So, speculative stocks, penny stocks, stocks without a strong track record of earnings and sales growth that have, estimates that aren't trending higher. A lot of those stocks tend to be more fragile in their patterns and have this kind of disaster happen. So we want to try to avoid these kind of trading scenarios where we don't have the fundamentals moving in the same direction as the price. So the first step in getting an edge in your trading, and by using these characteristics, by using this philosophy, is to define winning stocks. And the best stocks have either a strong, consistent growth track record and or rising estimates with a track record of beating those estimates. And that's important because analysts and the company can raise their earnings estimates, but if they don't consistently meet those expectations or beat those expectations, it's not as likely that they'll actually follow through. So, and analysts and top large investors who move the market with a lot of money being put in the market, they know this, and so we want to see the estimates rising and the track record of beating those estimates, and of course we want to find a bullish price trend, a bullish technical entry at the same time to go along with it to match that. And if you can combine these fundamental factors, these two key fundamental characteristics, and apply the right technical analysis to the stocks, you can do really well. And we do this in two ways in our trading. And the first one is taught on TradingPub.com, and the other one is taught on InvestBeFree.com. And the first one involves finding bullish, explosive chart patterns on elite growth stocks and UPOD BTE stocks. And that's, for those unfamiliar with the acronym UPOD, that means under promise, over deliver, and BTE stands for better than expected. So on TradingPub.com, we're looking at just these pool of stocks, and we carefully screen the stocks, and we look for any red flags in financials, and we look for a very bullish chart pattern, a bullish technical entry point on those stocks. And so that's TradingPub.com. And the other site that we have is InvestBeFree.com. And what this does, how this is different, is that it gets the same pool of stocks, the elite growth stocks, and also stocks that are beating estimates with rising estimates, future estimates. But then we use technical analysis on that site to just weed out the likely losers. And that has been very, very effective, and also allows us to deliver a system methodology that's very, very simple to implement. You wouldn't have to use technical analysis at all with that methodology. So, but getting back to TradingPub.com, here we're looking for the best technical entry points on stocks with the aforementioned fundamental characteristics. And in any given market, there's only a couple hundred or so that meet the strict requirements that we have. So we're only looking at the top momentum trading setups on top growth stocks, and the best swing trading channeling stock setups on companies with rising estimates that tend to beat those estimates. So we don't have many bad stocks or dog stocks that underperform in our newsletter. We have a no dogs allowed policy in that we want to find companies and trade stocks with rapidly improving fundamentals. And as I promised you before, we're going to look at a really good trading setup. So you guys can go out there and find this in your own trading, in your own stock screens, and hopefully find some very profitable trades for yourself. And this is an example from a recent daily alert newsletter. And in that newsletter, we're trying to find these great setups, technical trend and setups. And I don't know if there's a way to actually blow up this chart, so I apologize if it's a little fuzzy, but I don't think there is. So, but this is Alexion Pharmaceuticals. It's a biotech company, and this stock has the two key things that we look for. It has the very strong price trend, very good technicals in that respect, and it also has a very strong long-term uptrend. In fact, this uptrend extends back to the left of this chart a couple of years, and so this stock has been making a series of higher highs and higher lows for quite some time. It actually dipped a little bit here to take out a prior support level, but it formed a bullish chart pattern and broke out of that soon after. But for the most part, it's been in a strong uptrend for a few years, and it's riding this uptrend support for quite a while. But not only is it doing that, but the fundamentals are also matching that, and that's key. Like the earnings growth and the sales growth, at the time we featured the stock, we're averaging around 40% per year. And the stock recently, the time we featured it back in late July, the stock actually beat earnings estimates by a very wide margin, and also beat on the top line. They beat their sales estimates by a healthy amount as well. And oftentimes you'll see a stock, when that occurs, you'll see a stock pop up higher, make a short run, and then pull back or move sideways for a time before starting another leg higher. And that's exactly what this stock was doing at the time we featured it. And our target entry, as it always is once this short-term pullback back to its uptrend support is broken, and it's ready to start its next leg higher. And so that was target entry in the stock. And we jumped in, and we made quite a bit on this trade over the next few weeks. It went down to 100 and went back up to $117, $118 fairly quickly. And then in early October, we came out with a bearish market call, and we said to go ahead and get out of your long trades, and we did that as well, and made a nice profit on the stock before it corrected. One of the things you have to keep in mind when you do trade elite growth stocks, or any growth stock for that matter, or any speculative stock, is that once the market turns bearish and begins a new correction phase, those stocks tend to get hit the worst. So you got to keep a close eye on the market, as we do in our newsletter. And once you see a bearish market signal, you want to get out of that trade and take your profits and move on. So, but I want to just recap the characteristics that this stock had, and so you can go out and find it in your own trading. Again, we had a very strong, consistent long-term uptrend, stretching back years. There was low volatility during the trend. We didn't have a lot of, big moves up one day and then a sharp move down the next day, followed by 3 or 4 days of a sharp move higher, followed by a sharp sell-off after that. You didn't see a lot of that in the stock. There was times where the volatility was greater, but those that tended to subside over time, and the trading range narrowed before its next move higher. So that's the kind of behavior you want to see. And stock had 3 to 5 years of very strong earnings and sales growth. Now, companies that grow their earnings and sales quickly over 6 months' time, over a year's time. A lot of companies will do that, but there's only the elite growth stocks, the best growth stocks out there to trade, will have a consistent earnings and sales growth over a few years. So that's a key characteristic to look for. I mean, ideally, you want to see a very strong earnings beat recently, stock pulling back to an uptrend support or a horizontal support level. You have to excuse me. I have to grab a glass of water here. Gotta clear my throat. Okay. And so if you see that strong earnings beat, a good thing to do is to wait, 5 days, a week or two, until the stock breaks consolidation that often occurs after that big earnings release. And another characteristic this stock had too that I haven't mentioned yet was that it was in the biotech industry, and that was a leading industry at that point, as it was earlier in the year as well. But you want to find stocks that are in a very strong industry group, an industry group that has a very strong relative strength. And you also want to look for a great chart pattern to trade. A bullish cup with handle pattern, a flat base pattern, a high tight flag, some other strong chart pattern that tends to be bullish. And so this is what we look for in our newsletter, and we feature a lot of these stocks and these trading setups throughout the year on TradingPub.com. And you can also see more examples of which chart patterns to look for in our newsletter. And we've got quite a few that a lot of traders don't recognize or use that often, but are also very bullish and great chart patterns to understand and to trade. So you want to check that out in our blog and see what those are and learn from that. But I also want to mention too, we offer a free trial on TradingPub.com where you can just enter your name and email address on the homepage and get three weeks free of that newsletter to find more of those bullish trading setups. Now, I just want to recap some of the advantages of using this type of fundamental analysis with your technical analysis in your trading. And one real advantage of doing this is that you feel more confident not having a stop loss, a hard stop loss, when you're in a stock. And a lot of top traders out there will tell you they use mental stops, and they'll watch the stock closely, and if it drops below a key support level, they'll look at it and make a determination at that point, and either get out right away or they'll decide to hang on and wait for a rebound, depending on market conditions and other factors. So, and actually stop loss orders have been proven to tend to lower your results over time. That actually hurts your results over time in general. Of course, they let you sleep better at night, and if you're going on vacation or if you're away from your computer, it's a good thing to have in there too. But in general, we don't have hard stop loss orders. We have a mental stop, and we feel more comfortable and confident doing that because the stocks have the earnings that are increasing, the sales and earnings growth that are very strong. And as long as market conditions are okay for growth stocks and these type of trading setups on the long side, we'll go ahead and not put a stop loss order in there and just follow the stock each day and see if it closes below a key support level. So we're very comfortable doing that, and that's worked out well for us. And and these characteristics, these fundamental characteristics, have been proven to lead to higher prices anyway over the next month or two. So why wouldn't you, just focus on these stocks and look for the great technical entry points on those stocks? And if you're riding an uptrend in a stock with rising, improving fundamentals, if the stock does stop out, it often does at a higher higher level, oftentimes above where you bought the stock, because these stocks tend to have a rising support level, an uptrend support that moves higher over time as you go from left to right in the chart. So as time goes on, that stop loss rises, and if you do get stopped out, you often get stopped out sometimes get stopped out at a profit. So, and you have the peace of mind of knowing that you're using an intelligent approach to trading, taking into account both the technicals and the fundamentals. And historically, it's worked well. Okay, so that's TradingPub.com, and that's that approach. Now, the second approach I want to talk about is our brand new site, InvestBeFree.com, and this is a different approach in that we just have 3 of the top stocks each week, and all you have to do is model the portfolio on the site in your own trading account dedicated to this methodology. And once a week the newsletter comes out, and you would just need to make 1 or 2 trades per week on average to follow the portfolio. And so far the returns have been tremendous, even though it only costs you 10 or 15 minutes of your time, your precious time per week. So it takes much less time and doesn't require any technical analysis on your part. So if you're not wanting to spend a lot of time drawing on charts and putting the support levels on there, putting your Fibonacci lines on there, and really studying the technicals of a stock and a trade, then this would be a great approach for you while still trading and not investing so much. So this is a methodology that we started to investigate last year, and it's a very complex set of screens, but we backtested this approach without using any technical analysis, and we found that it would have quadrupled your money over the last 5 years before commissions and fees and slippage. So in that same time frame, from early 2007 to early 2012, the overall market went nowhere. Basically, it was basically flat. So you're looking at 10,000 becoming 10,000 if you're in an S&P index fund, versus 10,000 becoming 40,000. And if you would use this approach, over that 5-year time span. So once we saw the backtesting results, we knew that the criteria was based on characteristics that have been proven to work over time. So these are proven fundamental characteristics that we're screening for, and that gave us a lot of confidence that this methodology would work well on a live account. So we decided to apply this to a live account, one of our smaller trading accounts, over a 3.5-month period, and we found that the account grew at a nearly 200% annualized rate over the approximate 3.5-month test period. So I think it went from 42,000 to about 60,000 in that 3.5-month time period, and the overall market was up like 5 or 10%, and this methodology was up over 30%, I think like 35%, at a very, very high growth rates. And so after we saw the results in our own trading account, we decided to apply the same method, or deliver this methodology to our subscribers on TradingPub.com. So we launched the site and brought this to our audience there. And in the first 5 months, from April 12th, which is when we launched the site, to September 12th, we saw the portfolio make huge gains. And this is an example of a chart. Again, I apologize for it being small. I don't know if you can actually increase the size on your own computer, but I can let you know that the count of a hypothetical $30,000 account would have grown into over $40,000. And these 3 lines here are comparing a market order approach and a limit order approach and another limit order approach, and comparing the results, market orders versus or limit orders versus just market orders. So, but we've seen huge gains in just the 5 months of this newsletter, and so it continues to work very, very well. Just to highlight some of the performance we've had so far in the first 5 months of this newsletter, We saw 8 weeks in a row of 2% to 5% gains back in July and August and early September. Gains of over 34%, while the S&P 500 gained just 4.96% over those first 5 months. Now this is a near triple-digit annualized gain, assuming you reinvest the proceeds each week, and that is very easy to do with this approach because, again, you're only making on average 1 or 2 trades per week, and you're just trading out of one stock and moving that money into another stock. So you have the money split up approximately into approximately 3 ways. So if you have $30,000, you would approximately have $10,000 in each stock each week. And one of the great things about this is that when we apply technical analysis to weed out the likely losers, we found that we are actually beating the backtesting results. So, and these results are greatly exceeding our own expectations. And again, it just takes a few minutes per week with our newsletter. It requires no leverage of any kind. You have shorting, options, or more margin to make these huge returns. A lot of systems out there will tout these kind of returns, but they do involve shorting in general. The ones that I've seen, they involve options or margin or some kind of leverage to make these huge returns. Whereas this methodology that I'm showing you involves no shorting of any kind, no options, no margin of any kind. So, and it's a very, very hot system. It has been for many years. And I'm going to give you an offer for those watching today. For many of you, I'll be giving you a special offer to join the site over the next few days. Yeah, you might want to go to the site and sign up for our mailing list so you can be sure to receive that special offer. And while you're there, there's also free videos, a free video course on the methodology, which will explain more to you. So you want to go check that out as well. And also I wanted to offer a special on our book that's sold on TradingPub.com that goes into these fundamental characteristics that matter even more. And but first, I want to let you know that before I complete the presentation, that we are members of the Better Business Bureau. We do have a lot of integrity in the way we run our business. We've been in business for 8 years, and we've been a member of the Bureau for the past 6 years, and we have an A rating with the Better Business Bureau. And my book that I just mentioned is on our site, and you just go to the site, tradingpub.com, and click on the special offer button on the home page there, and that will give you $12 off the regular price of our book, and also give you a free month of our daily alert service. And again, you can learn about the stock screeners we use, how we identify quality technical entry points on stocks, our buy-sell rules and details in that book. So take advantage of that opportunity. And you also learn about how we time the market, our favorite bullish and bearish market signals, and how we use those to know when to go bearish, when to go short. On TradingPub.com, we don't do any shorting on InvestBeFree, but with TradingPub, we do have short setups when the market is turning over, and we are just starting to go bearish, I should say, on the market. We went bearish using these techniques right before the steep sell-offs in 2008, and also right before the flash crash in 2010 and in early October of this year, before the fairly sharp pullback we've seen since then. And so we'll explain more about how we, in pretty good detail about how we analyze the market and figure out when to go bullish or bearish. So also receive with that book a free month of the daily alert newsletter, and you also get a 15% discount after that if you decide to keep the subscription. So I just want to mention that to you as well. So, but I just want to go ahead and just answer a couple questions. I only have 3 minutes here left, it looks like. If there's anyone that has a question about either site, I'd be happy to answer them now. And I've got one here from Johnny Lash. those two separate websites? And the answer is yes. There's TradingPub.com, and that's for those that like to use technical analysis, who like to have technical entry points and exits, and like to follow the charts and our buy-sell rules. There's also InvestBeFree.com, and that's the methodology we came out this year with, and that requires no technical analysis on your part. You can apply technical analysis to the stocks if you choose, but it's not required. And it's just a newsletter that comes out once a week and requires just a few minutes of your time per week. So you don't have to spend hours and hours studying charts and learning technical analysis. You can just spend a few minutes per week and still profit from this methodology. So, and another question from Johnny: how much for InvestBeFree.com? That site, because of the high performance and the proven performance that, with the stocks on TradingPub.com, it's difficult to analyze returns because it's based off of the uptrend supports. So you can't really mechanically returns. But with InvestBeFree, we have been able to with backtesting results and the live portfolio, and also the newsletter over the past few weeks. It's much easier to calculate those estimated returns. So with the performance of that methodology, we do charge more for it. It also doesn't require as much time, but the annual price for that is $1,400, $1,497 per year. That's $1,497 per year. But I'll be sending out a special offer to try it, so you can take part in it at a much lower cost here in the next few days. So if you decide you want to check that out or possibly join, wait for that email, or go to our site and sign up for a mailing list. You should probably do that, because not everyone seeing this presentation will receive that special offer. So I would go ahead and sign up for that video series on the site. I'll be sure to send a special offer out to those folks as well. So is there any other questions out there? Okay. Yeah, I can take that question, Johnny, offline. We did have a free trial that started on Saturday. That was our one and only free trial for 5 days. And I can help you track down any issues that you had with the login or password, but it's really straightforward. So I'll go ahead and email me offline at info@investbefree.com, and I'll go ahead and look that up for you and take care of that for you. So I think that's about all the time I have. I'm going to go ahead and pass it back over to Chuck. Chuck, are you still out there?